Hi, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about reducing your stress from buying an annuity. Okay, full disclosure, I just want you to know that I invested a ton of money in the stock market just last week. Okay. And today is a down day. And there were a couple days before today where it was really, really down. And it's no fun when you put money in stocks. And I put my money in an ETF, S&P 500, and I bought some Tesla stock and bought some Nvidia and did pretty good for a little bit. And then it went down and then went up and then went down, right? That can be very, very stressful. Now, as you can see, for me, I am younger. Like I am not as close to retirement as a lot of people that I help. Okay. I am in my mid 40s. Okay. I've got 5 kids. I'm not going to retire for probably 30 or 40 years from now. I plan on working a long time. But at the same time, for me, especially as I get closer, okay, maybe when I'm like 55 or 60, I might get a little nervous. I might think, well, only got a few years left to retirement. What if I have like 4 or 5 years where the market is down? That can seriously hamper everything and reduce or change my retirement age. And that's just not something that I want to happen. Okay. And so what do? I buy annuities. Okay. So for me and my wife, she doesn't invest. She doesn't buy stocks or bonds or ETFs. She doesn't do any of that. She doesn't know how to do that. Okay. I've done that for 20 years. So I know how to do that, but I still know what it feels like to be stressed out when you have your money in there and you have it invested and you have the market drop like 10%. It's a horrible feeling. Okay. And it doesn't matter how well you know the market. It doesn't matter that you know it's going to go back up. It's still not fun. And it still makes you emotional and it still makes you want to pull out. Okay. And oftentimes we do pull out. Even against our best judgment, we will do it. So here's really where annuities come into play. Okay. When you're looking for peace of mind, okay, you want to reduce stress at retirement, you should consider a contract of income. Okay. It basically takes a portion of your portfolio and places it into guarantees. Okay, this is the same thing that Babe Ruth did. Okay, Shaquille O'Neal, he did it too, to the tune of millions and millions every year. Okay, he did it for himself, did it for his family. He believed in them, and he's a very good businessman. He's invested in other things and made a ton of money. Okay, so he believes in growth too. And that's why a lot of guys will say, oh, annuities are so horrible because you should be in the market. You should just be in the market. You should be in mutual funds or whatever. Okay, the problem is, yes, I agree. You should be in the market. You should have growth as much as possible, but you should also have some guarantees set aside, especially if you want to reduce your stress. Okay. If you want to have less, if you want to sleep at night, okay, you want to have less fear, then having contracts in place really helps. See, for me, like my wife, she does not invest. Okay. She's not going to know how to invest. Okay, she might take my recommendations if I pass away and say, well, you do this and this and this, but she's going to be nervous about it. And so it's just better for us to have annuity contracts because if we have joint payouts, if I pass away, she's not going to have to worry about the stock account over here or what should I do? John did this. What should I do with it? Should I sell it? Should I stay in? She's not going to care because she's got these annuity contracts that are giving her income every single year without fail. She's got monthly deposits coming in every single month into her account from these annuity contracts. Even if the annuity contracts go dry, okay, especially with income ones, they're designed for the account balance. The account balance is not going to last. Probably last maybe 15, 20 years at most, especially if you're looking for a high income product. But you're not buying it for that. You're buying it for income. You basically purchase a pension. So you got $1 million. You're like, oh, I'm going to take half of it. I'm going to purchase a pension. Great. Got my pension. I'm good. Let the other $500,000 grow and grow and grow and grow and compound. And when the market's down 30%, yeah, sure, I'll see it down. I'm like, oh, that's a bummer. But at least I got my income over here, right? My income's coming in. It's feeding me. It's feeding my family. I can still go on that vacation. I can still go on that cruise that we were hoping to go on instead of saying, oh, we can't do it now. Our Nvidia stock is down today. And I just don't feel like buying these tickets because I feel less wealthy and I feel more crunched and I'm not going to do it. And that's how people live sometimes because they don't have these guarantees set up. And when you have a guarantee set up and you know the income's coming in month after month after month, you're like, I'm good. Yeah, the market will come back. Maybe it doesn't come back this year. Maybe it takes 5 years to come back, but it'll come back. And in the meantime, I'm still taking my income. So anyways, it's up to you. I mean, but in my opinion, if you're looking for highest a peace of mind, having an annuity contract in place really, really helps. Okay, I'm going to share my screen real quick because I want you to see visually what this looks like. And you'll see this in a lot of my videos. I share my screen and I want you to see what these look like. And if you want to go to my website, johnstevenson.com, you will see lots of annuity calculators. And if you want to see the highest annual income, it's usually the income rider. So do that, and then you can contact me and book a call there, or there's a link below this video if you want to book a call, and we can talk about annuities for you and your retirement. So looking at my screen, here's what I did, is I just basically took a couple. They live in California. One is 56 and the spouse is 52. And you'll notice that they put $450,000 in. This isn't all of their portfolio. Okay, they've got, $1.2 million sitting somewhere else, and they decided that they want to take $450,000 of it right now from an old 401k that they had from a past employer, because they can touch that before 59 and a half. And they decided to take that and put that into an annuity contract to give them peace of mind, because the market's going like crazy and they're just like, I'm sick of this. I want some guarantees. I want to take advantage of some high rates. And so I'm going to lock in income. And I'm going to let the rest of my investments, because they got their investments in a current 401k, they're going to let those continue to grow, okay? And they're going to continue to contribute to it, okay? And they're going to have market risk, but they're fine with it because they've got this contract set in place. Now, for them, they're going to wait until they are 65 because of Medicare, because they don't want to pay for health insurance and they just want to be able to just have a nice slide into retirement without having these huge health insurance premiums before 65. So they're going to retire at 65. The spouse is 61, and they want joint income. Okay. They want joint income that is guaranteed never to go down. So that's what we do. We look at what are the highest payouts based off of this amount. All right. So we got Delaware here. We got Midland, another Delaware. And let's see, North American, Corbridge. Let's see. Top annuity per carrier. That's a little bit better. Cleans it up a little bit. There's a lot of options that carriers will give you, just depending on, benefits and little, if you want like a LTC benefit, some of them will have doublers for that. But most of them have that. You can see right here, Midland has it right here, enhanced payments. That's kind of nice. So if I was to choose between these two, I'd probably say Midland. I mean, Delaware is good too, but they're a little bit newer, and the rating for Midland is a lot higher, and they're a lot older, and the income's almost the same. So if it was a huge difference, I would say split it up. Nothing wrong with using Delaware. They're a great company. But maybe you want to just put a smaller amount there and put another amount in another company and just kind of spread it out. People do that all the time. So if we look at Midland, let's just see I want to see what the LTC benefit is here. All right, so they are doubling it. So that's nice. So it's $110,000 if you can't do 2 out of the 6 daily living activities, which is nice, but it doesn't last. I mean, it's there for a few years. Let's see what it looks like at the index growth and the account happens. It lasts a little bit longer. That's kind of nice, but it only lasts your mid 70s. So after that, it's gone, because they're just basically liquidating your account to give you more income when you need it the most. And then it just goes back to the 55,000. Anyways, what you just need to focus on is the 110. That's a nice little extra side benefit, but don't count on it because you're probably not going to need it. Really what you're getting this for is lifetime pension. And that's what these people want to do. They're saying, all right, at 65, we're going to take our Social Security, which is going to be $40,000 for the husband. And then the wife, she's going to get half of the husband's because she didn't work. And so it's going to be $60,000 plus $55,000 for this. Pretty good. They're at $115,000 per year in income, which is a little bit more than they're earning right now. So that's really good. And they haven't even touched their current 401k. Okay, they've just used this from an old 401k. And so now they can let that other one grow. And then as it grows, maybe every 10 years, they'll strip off more money and they'll buy another annuity contract. And they'll just keep on adding to their income while still allowing their portfolio to grow. Okay, so it gives you the best of both worlds. So be wary when someone says, you only need to do mutual funds. That's it. That's the only answer ever. Okay, or stock, or you definitely need to have a hedge fund or index or whatever, or annuities. They're the only answer. Please give me your money, because boy, this one pays me a lot of commissions. You'll have guys that do that. So here's the thing. There's nothing wrong with having both. There's nothing wrong with having a balanced portfolio. I love risk. I love it. Okay. I love buying stocks. I love buying ETFs. Okay. I did a $200,000 investment into a new startup last year. I hope it makes me money. I don't know if it will. I might lose it. But you know what? I have more peace of mind knowing that the annuity contracts are going to be in place for me and my wife. That's what's nice. And that's what we're going to count on. That allows me to think clearly when I look at investments And when investments don't go my way, or at least by my timing, I'm okay with it, okay? Because I've got the guarantees set aside, okay? So anyways, just want to hit home on that so you can kind of see what is available. And if you want to book a call, you want to talk about annuities for your situation, for your retirement, book a call. There is a link below this video. It goes directly to my calendar, and I'd be happy to answer your questions if that's what you're looking to do. So if you would like to just check out annuities, you want to see rates, you want to see what they're paying, if you want to see what the income rider payout is, go to my website, johnstevenson.com, and you will see all the payouts. So, just keep in mind with some of these payouts, some of them are accelerated, especially for the income rider, where basically what it means is they give you a little bit higher income in the beginning and then lower it. And so a lot of times those companies are Ameritas, American National, and NASA. Sometimes Athene will creep in there. But I'll be able to explain that to you when you get on a call. We can go over all the options. I mean, I'll just show you real quick on my screen just so you can kind of see what to expect. So you see here, $55,000. Great. Highest income never goes down. Okay. If I unclick this box, no income reduction. Okay. It's going to show everything in the planet. Okay. Oh, wow. Look at that. 63,000. But guess what? They lower it to 36,000 later on. So they give you 63,000 for like 5 years, 5 to 8 years. It's like an accelerated payout for people that, maybe they're sick or maybe they just want a vacation. They want higher income early for a lower income later on for life. So I don't usually recommend those, but just keep in mind that when you do look through the income rider calculator, you will see some of those on the top. And just keep in mind that, in my opinion, my recommendation is always to stick with the annuities that give you the highest payout for life and never, ever, ever goes down. And so you can see right now that is Delaware and that is Midland. So highest payout and when we're looking at lifetime income, that's excellent. What are we looking at? $1.7 million in pension income from only $450,000. And that's only if you live to 95. Okay. And again, this is based off of the husband's age. The wife is like, 89 or 90? And so she lives another 10 years. She's going to take another $500,000 out. Now you've got a pension that's worth like $2.3 million. See what I mean? When you set these up, it just gives you the peace of mind knowing that you're going to be all right. And it allows you to invest in other ways that maybe you wouldn't because you've got all your money in one basket. And I hate it when advisors will just push one product. It's not one product. It's a solution. You got to push a solution for your clients. And that oftentimes involves a lot of different things. It involves some guarantees. It involves some risk. Okay. But when you have a proper allocation, it certainly helps people sleep at night, helps them be better investors. Maybe it makes the advisor a little bit less money because they don't get to have the assets under management. But in my opinion, it's best for the client. So anyways, hope that helps. Again, appreciate you watching. If you like the video, like, subscribe, share, comment below. I'll answer. Look forward to chatting with you. If you want to book a call, there's a link below the video. There's a link on my website, johnstevenson.com. And if you are looking for an annuity for your retirement, I'd love to help. So again, thanks for watching. We'll see you next time.